Hiren Ben joins us. Let's connect with him. Let's talk markets, view for 2025. And you were supposed to go on Friday, right?
I got stuck in traffic.
Bad traffic. Bad traffic. Today it was good.
I started early.
Once bitten, twice
It took him
shy.
2.5 days to make it. The traffic was that bad, is what he's trying to say.
I know he's planning for marathon, but I didn't know you were that dedicated.
I also chose a better day when the Nifty is green.
No, I know you're planning
Hardly.
marathon, but I didn't know that it was like, चल के और भाग के office भी जाएंगे.
वो भी कर सकते हैं.
Markets are not in a marathon mode. They are just not here, not there. Are we in for more of the same where we just stay in this range for an extended period of time?
Yeah, I mean, very well could be, because I think, everybody wants to wait and see how the results pan out, because we had a soft patch in the economy. We had a soft patch when it came to results in Q2. And also, everybody is waiting for what Trump is going to do. And then we also have the budget, right? So typically when you have so many events, then very difficult to see that you will have any great directional one way or the other. So I think, the market's been in a corrective consolidation phase for a while now, and it might continue for some time. But I think the biggest catalyst to my mind, more than anything else, could be the result season, frankly. Because once there is confidence that earnings can come back and growth can come back in Q4, I think the markets can get back to the races.
But that's the confusing part, right? Because we were just looking at Bajaj Finance and HDFC Bank's performance, for instance, in the quarterly updates. Divergent trends. RBL, IndusInd Bank, Bandhan, a different tune altogether. MFI is doing their completely different jig.
Yeah.
What is that telling you about how the quarterly performance from financials as a cluster is going to be like?
So I think by and large financials is still more constrained by credit growth, right? The problem with the banks, as you can see from the HDFC update, is that while they've done very well on deposits, but they'd had to sacrifice advance growth, right? So I think, and that's the problem, that adjustment still continues where everybody needs to shore up their deposit growth and moderate their advances growth. And we have seen a spike in unsecured lending. Obviously, MFI is at the extreme corner of that. But I think unsecured lending has, we've seen a little bit of a spike. So I think, this sector, the lending sector to me is likely to be, as a whole, very middling in its performance. There may be some standout performers. And I think Bajaj finally seems to be coming out of that kind of middling performance where, there was a lot of confidence that came back during the Bajaj Day that they did a couple of weeks back. And I think when the rest of the big banks are thinking of compounding or growing at 12 to 14 or 15, 16%, if Bajaj can grow at 25%, that's a great differential growth rate, right? So I think you'll have to pick and choose, but on the whole, I'm not very excited about lending as a space. I think capital markets is a far better place to be in on a structural basis, right? There could always be a few stocks that can be an exception to the rule, but I think non-lending financials is where I think the action is going to be. So wealth managers, brokers, asset managers, I think that's where money is going to be made on a structural basis. Because it's very clear, right? If the depositor is moving from not putting deposits to doing SIPs, you better be on that side of the balance sheet.
Fair point.
Yeah, and structurally they look strong, even though there can be these transitional issues with SEBI coming up with new rules and the volumes getting hit in the very near term. Maybe the structural story is intact. We talked about financials and the Q3 update, but what about the updates coming in from consumption basket? Because we got the numbers right now from Titan, Jubilant Foodwork, Macrotech developers. The luxury side is still doing okay. Avenue gave us the indication that perhaps Mars is trying to pick up, but would you buy that yet?
So I think again, what at least what I get to understand from the Q3 updates is that from a very challenging situation, you're getting to a little bit less challenging situation, right? So it's all about incremental improvement on a quarter-on-quarter basis. I think structurally still the lower end of the consumption trend is still quite soft. We may see improvement from absolute bottoms, and I think the stocks are also reflecting that because the stocks have not done anything for a long period of time. So sometimes more than the performance, it's actually what you deliver versus consensus expectations. So if the expectations are so low and you do slightly better, the stocks can do better, right? So I think again, like in financials, I think in the consumption basket, we still believe that the more discretionary, higher ticket consumption will probably do better, because there the consumer's balance sheet has generally been very healthy, right? I mean, a stock portfolio is up, his gold is up, real estate is up, and I think that that's where the momentum is. So whether it is premium real estate or otherwise, if you want to do lower end consumption, then I think you are better off buying the platforms, because they are aggregating demand across all segments and growing faster than, let's say, an individual FMCG company, right? I mean, a Marico or a Lever is still struggling to do single digit growth. The platforms are still delivering you 20, 25, 30% growth. And I think that's where the story is.
Hiren, so, every year we get new themes. It's time to look in the other direction. Where are you looking in this year the other way, which is that either it's a new theme or it's a contra approach, or you think that little bit of surprise could re-rate these stocks?
So as I said, I haven't changed anything dramatically from where we are, right? Our portfolio positioning is largely across 4 large themes, right? One is manufacturing. Within that, there are sub-themes like EMS, power transmission, cap goods, CDMO. I mean, this is one big theme. Second is platforms and tech. Third is higher end consumption, right? So broadly, we've stayed with the themes. I think what could happen this year is that some of the so-called high quality compounders which didn't do anything for a long period of time, right? And I think 2 of them, for example, have given very good numbers, Bajaj being one, Eicher being the other one, right? I mean, some of these might surprise and start growing again. And I think that's where people have kind of given up, or where they've underperformed the Nifty for the last 3-4 years, but incrementally they seem to be coming back. For example, Eicher's market share at the low was 48%. They are now back to healthy levels of market share. We've seen they've taken price corrections, volumes are coming back. So I think the opportunity this year could really be that out of those 10, 15 great compounding stocks which haven't done anything great for the last 3-4 years, maybe 2-3 of them can surprise and start doing well. As I said, Bajaj, Eicher come to my mind very
Reliance
clearly.
also.
We haven't seen anything great happening there. Unfortunately, the oil and gas business profits are pretty much in a range. In retail, they seem to be having the same challenges at the lower end. I think the only potential is that if they take another tariff hike in Jio, right? So I think there's a lot of work that needs to be done, and markets are very smart. If you don't grow and your return on capital is 10-11%, then there's nothing.
And debt has gone up, unlike what they indicated.
Exactly.
That gross
I think debt's again gone up, right? So I think there is a little more work there that needs to be done. I think the stock's fairly valued now. I mean, in the sense that there's not much downside from here. How much upside you can capture really depends on how much growth they can dial back again in their businesses.
So Hiren, you've talked about your tactical ideas and your structural themes as well. But in, say, the next 2 to 3 years, what could be those high growth potential sectors? Would it continue to be the platform companies?
Yeah, I mean, I think there is a structural shift that is happening, right? So what happened actually is that post Demon and GST, you actually saw consolidation, right? So the more organized, the big brands became bigger, the bigger companies became bigger. But then came the platforms, and you're now actually seeing fragmentation again, right? So you have smaller brands in food, smaller brands in cosmetics, smaller brands who are coming and challenging the bigger players, right? So you had consolidation, and now you actually have fragmentation because of this tech platform is enabling you to allow that. And I think that's where the challenge really is. And then, therefore, I believe that technology, and whether it's tech-driven financial services or tech-driven consumption, is where growth is likely to be. And these guys are very innovative, right? Once the platform has been built, you're doing food delivery, you're doing quick commerce, you're creating businesses. You're creating an entertainment business on the same platform by doing district. So I think that there is a little bit more innovation, and what we've been all saying that India's tech stack is great, but this is really the benefit that we are seeing of the tech stack, which has enabled entrepreneurs, first generation entrepreneurs, to come and build phenomenal businesses. But it takes time. They make mistakes. They were burning money to acquire customers. I think now a few of them have come to a stage where they've achieved scale, right? They have 250, 300 million customers. They have 50, 70, 80 million customers who are paying. And I think that's where the real growth is going to be. So I think in many industries, a lot of business models are changing, right? I remember very clearly Uday Bhai saying a couple of years ago that all the banks missed the UPI story. Because everybody thought there's no money in UPI. Why should I spend money, creating and adding customers on UPI? But now people realize that UPI was just a hook. You go there, you go on the platform, you transact, you pay your bills, you buy stuff. And because you are on the platform and the customer is sticky because it's like a utility, you keep going back, then you can cross-sell other financial services to that platform. And, so I think what we are seeing in the last 3-4 years is that traditional mindset that, okay, organized, big brands, deep distribution, all that is getting disrupted at a very fast pace, right? I mean, the Levers and the ITCs and the Maricos of the world spent decades building deep distribution. Today, a D2C brand can come, they can hire a third-party logistics guy, they can advertise on any platform, and they can get going, right? So, a lot of businesses are getting disrupted, and the old order is likely to change, but it takes time. And the way sometimes it manifests is that those stocks just don't do anything for years together. Yeah. There is a very steady derating that happens. So I think for us it's very clear, where is the growth? Where is the consumer going, right? If the consumer markets on the whole are growing in single digits, but somebody is able to capture 25-30% growth, then I think the value is going to be created there. Obviously, these companies also need to make cash flows. And all of them are now focusing on profitability and cash flows. So I think that's where the growth is going to be.
That means you'll buy Honasa?
No.
But they're doing exactly what you wanted, right?
But again, you have to be, just because you're a platform doesn't mean that you will do well, right? I mean, platform is just a euphemism of saying that these business models are now trying to disrupt, but you still need to execute well.
Would you find a winner in the consumer space? I'll just break this point for the benefit of our viewers. 10 years ago, it appeared that Patanjali is going to eat into HUL's market share.
Yeah.
But today, HUL has added a Patanjali's turnover in 5 years.
Yeah.
India's number one FMCG company is still HUL.
Yes.
ITC has caught up. Britannia is still there.
Yeah.
So while there are a lot of great small D2D brands, they've not really managed to make a mark.
I agree.
So could that be the challenge for the FMCG space?
Look, I mean, Bharat is still where, 400, 500 million customers. So I'm not saying that these companies will become irrelevant. I just believe that in this cycle, there is a lot of disruption. They have a growth challenge. Their starting valuations were high. See, there was a time, if you go back, Lever used to compound at 25% a year. They were making acquisitions like Tomco, they were acquiring brands. But those were the times when they were able to eke out strong compounding growth. Today, they are great companies, right? But unfortunately, the consumers have shifted. Now, you've achieved penetration in soaps and detergents and so on and so forth. So I think that it's not that these companies will become irrelevant. It's just that post-COVID, what has happened is that the consumer at the bottom end has really lost purchasing power. Yeah. And it's taking time for him to rebuild. Also, the consumer's preferences are changing. As you know, recently data came, they're now spending less on food and more on consumer discretionary stuff. Now, the question is, who's able to capture that client more efficiently?
She said Finance Minister, I think, mentioned somewhere that for the first time, Indian basket is 50% lower in food now. Earlier, the average Indian spend of the basket was 50% in food. Now, for the first time, it's gone below 50% and they're happy about it. I mean, it's actually
true. Because as incomes grow and now, you move beyond the necessity to the next big thing that you want to do, right? And the other thing, I still believe that, you mentioned about where the growth could be, right? I mean, today itself, I think in ET there is a lead article about the government wanting to incentivize component manufacturing. I think EMS is a big growth area. I know stocks have done phenomenally well, but this reminds me of how IT services grew. Every small, big, medium-sized IT services company grew because the opportunity was so big. And I think manufacturing is a large opportunity within which I think whether you call it power T&D, electronic manufacturing, I think the largest company is Dixon, which is $2 billion. If it's a $70-80 billion opportunity, I'm sure there will be few companies that will become $4, $5, $6 billion companies, right? Again, I'm saying you need to be careful about what valuations you pay. But I just feel that growth is emerging in completely new areas. It's not where we used to traditionally look at, right? And that's both interesting and challenging. But then what happens also is that there are areas that you ignore for a long period of time. Expectations are very low. These companies are still high quality companies and they do better than expectations, and then incrementally, you could have short bursts of medium term where these companies can do well. But I think the key is that you create a portfolio where a large part is in structural themes, and then you also play some of those areas where the businesses are great, but there's so much of pessimism priced into those businesses that at some point in time they become very attractive to own, right?
Sure. No, I have a slightly different question here. Sure, the EMS theme is something which is very secular. How do you decide that you want to pick up, let's say, Dixon and not the Canes or Amber and all of that of the word? Because Dixon has become, 3x just last year? Even Trent, for that matter, which is one of your holdings, has become 3x. How do you decide to sell that or diversify into other names?
Very interesting question. I mean, it would take a couple of hours to answer that question. But again, taking the analogy, right? So when you have a large opportunity, there are several ways to play it. Sometimes you buy an entire basket and the whole basket will do well. I remember during the tech boom, you bought Wipro, you bought TCS, at that time it used to be called Mphasis BFL, PSI Data Systems, VisualSoft, right? Everything did well. Over time, you get to differentiate because you start looking not just at simple growth, you start looking at many more metrics, right? And then you start seeing, okay, why should Dixon trade at the multiple that it is trading? Because it has the best working capital management than any other EMS company. But then you start segmenting. You said, okay, if I want to play EMS in consumer, I'll play Dixon. But if I want to play EMS in industrials, then I would buy Keynes or Sirma or something else, right? So as you get more insights into the business, eventually you will find that returns start to disperse, and the better execution guys get far better returns. It happened in NBFCs. Why Bajaj did better than somebody else, right? And there are so many other NBFCs who tried to do what Bajaj was trying to do, but failed, right? I don't want to name, but there was one great NBFC who tried to do what Bajaj was trying to do, and they've stumbled. So then it's really about execution. The opportunity is big. So there'll be 10 EMS companies who will try to grow because the opportunity is there for everybody to grow. But which are those 2-3 who will execute the hell out of that opportunity with the best margins, the best return on capital, the most disciplined capital allocation? I think that's where the big money is. This is age old. I mean, why is it that Trent has outdid everybody else? Because they just executed so well on that opportunity. So I'm saying beyond just identifying the opportunity, you then have to really look, go down and open your balance sheets and look at how each management team is executing. And generally the market is very smart, right? If you make a table of 10 companies, you'll have the highest to the lowest P. Broadly speaking, the market's figured out who are the very good executors because they eventually get a higher P multiple. And what people try to do is that, this is very high, let me buy this cheaper one. Yeah, but very seldom do you get that the cheap guy becomes. Sometimes you do, but it's usually the best guy who continues to execute well, right? I mean, so again, there's no one single answer because every sector has different dynamics, but broadly, I think, you first catch the big trend. If you can't differentiate between A, B and C, you just buy the whole basket. Over time, you learn much deeper about the sector and you start differentiating. These are the 2-3 horses that I want to back if I want to play this, this secular theme.
So across your portfolio, which are those 2-3 horses which you are completely convinced about the valuation that they're trading, about the story that it is?
I will not.
Dive,
Unfortunately, I can't comment on single names for
the declared portfolio.
Yeah, I mean, so we do have exposure to Dixon, but it's not something that we bought now. We've been invested post-COVID, so it's really done well for us. I do believe that just like Dixon on the industrial side, probably Keynes is showing those colors where they seem to be getting their act together fairly well. CG Power has done well, but we don't own it, right? I mean, as one. We do own Trent. Again, it's something that we own for 12 years. So, don't blame me for buying today at current valuations. But so in consumers, Trent, United Spirits, Varun Beverages, these are Zomato, these are our big bets on the consumer side. On manufacturing, we own Dixon. We own all the cap goods guys, ABB, Siemens, Hitachi, GE, the entire value chain across power and cap goods, we own that. In platforms, we own MCX, which has done fairly well. So I think that
You've not bought
Paytm is another one that we own.
You've not bought the new fancy solar names or the so-called energy transition stocks, the green and clean names?
So I think we, again, I mean, we've played the energy transition story through the cap goods companies, right? So they all feed into multiple sectors, right? When you're buying a Hitachi or a GE or an ABB, you essentially get to play several end user industries, including renewables as well, right? So yeah, I mean, I think again, there are several ways to skin the same cat. I mean, you just have to figure out your most, efficient way to do it.
Well, wonderful. Best wishes for 2025. And
thank you.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.